This is the Daily Market Comment by Harlan Bospiceros. I'm Maria Pachurdiz. Thanks for joining us at XM.com. The US dollar slid against all the other currencies on Thursday, with the main gainers being the yen and the euro. Once again, the US inflation data proved to be the greenback's biggest nightmare. Both the headline and core CPI rates for December declined to 6.5% year over year and 5.7% year over year from 7.1% and 6.0% respectively, matching the forecasts. However, what came as a surprise and perhaps prompted traders to enter larger dollar short positions may have been the monthly print. Instead of stagnating as the forecast suggested, consumer prices declined 0.1% month over month, adding credence to the view that inflation may be on a sustained downtrend. With all that in mind, investors may now be more confident that the Fed would eventually need to cut rates at some point this year, despite a couple of policymakers stressing the need for further tightening after the data came out. The yen was the biggest gainer among the major currencies, with dollar-yen falling more than 3% yesterday and today in Asia, and confirming a lower low on the daily chart. Following yesterday's reports that Bank of Japan officials may proceed with additional action to correct distortions in the yield curve, the slowdown in U.S. inflation backed the view that the Bank of Japan may be starting its own tightening crusade at a time when the Fed is headed for the exit. The euro took second place as yesterday's inflation numbers strengthened the belief that, with underlying price pressures in the eurozone still accelerating, the ECB may need to continue tightening more aggressively than the Fed henceforth. Equities were also affected by the U.S. inflation data, with European and U.S. indices extending their gains. Only Japan's Nikkei 225 fell sharply today, feeling the heat of the surge in the yen and Japanese government bond yields. However, the prospect of lower interest rates in the U.S. may not be a reason for a long-lasting party if economic data continue to point to deeper wounds. After all, a weak economy is anything but positive for firms and their earnings. The earnings season begins today with results from several big U.S. banks. Overall, S&P 500 earnings are expected to have declined year over year in the fourth quarter, which would be the first negative rate since 2020. Although slightly better than expected numbers could result in a relief bounce in the S&P 500, a generally weak picture could leave the door for another slide open. This was today's Daily Market Comment. Thanks for joining us at XM.com.